Welcome to Investors Insights, episode number 165. Today we will be discussing the crossroads and pivotal points we're at in the market and the economy. So let's jump right in.
You're listening to Investors Insights with Greg Powell and the Portfolio Strategy team from Five Plan Partners.
Good morning, gentlemen.
Morning.
So great discussion this morning. One of the things that we talked about this morning was accountability, and accountability being from the standpoint at the first of the year, we threw out the possibilities that this was the year of women. Mm-hmm. In fact, we sent it out in letter form. We put it out in blog form. It was in our e-newsletter. Well, here we are at a pivotal point this week, and women play a key role, and especially this month. Today, as we're making this vlog, Janet Yellen, as we all discussed, and Janet Yellen is going to be talking about the Fed, and are we going to see possible rate increases? Number two, tomorrow on June 7th, Hilary Clinton and Bernie Sanders go at it to determine if they're going, who's going to get the state of California. And then later this month, June 23rd, we're going to look and see if Great Britain exits the European Union. And Angela Merkle over in Germany, who has been a stronghold on keeping the European Union together, is going to play a key role. So from an accountability standpoint, we like to say, yes, we mentioned this, and if we're right, we're going to tell you we're right. If we were wrong, we're going to tell you where our miscalculations were. But so far, things have been on track. Yeah. On that note, Bobby, you brought up some good points about Janet Yellen and some conversation there on numbers. Talk about that.
Yeah, so last week was all about the disappointing jobs report that came out on Friday. 38,000 jobs were created. Expectations were for over 160,000, so that was a big miss.
Right.
A couple of points on that. Of the 38,000 jobs that were created, they were mostly part-time jobs. And it's, that's the worst job growth we've had since November 2010.
Right.
Heading in the wrong direction. Also, one of the shocking headlines is it's the second consecutive month that we've had a full-time job loss. Net loss in full-time jobs. That's not good. And obviously with Janet Yellen speaking this afternoon, I would imagine her speechwriters had a long weekend of rewriting the speech of what are we doing now? And so I think our consensus thought is they will have a hard time raising rates in 2 weeks with the Brexit vote. That's on everybody's minds. So.
Right.
And we saw the unemployment rate surprisingly come down, but that again gets to the part-time jobs and people just leaving the workforce.
Yeah, I think over 500,000 jobs or people left the workforce.
Mm-hmm.
So
right. We have continued to talk about technology taking jobs away too, and that plays a key role too. Just in terms of the re-education, the retooling of America, we're in that transition time period. So there are jobs that people are going for that are now going away, and they need to either get re-educated or find a different position. And that's a theme in this election.
Yep.
So it's also one of the reasons people are really hacked off during this election.
Yeah, I think at this point, the only reason they would raise rates in 2 weeks is if they thought that, the economy's not looking good. We could have a downturn here in the next 6 to 12 months, and that would give them ammo and more room to pull back.
So, right. So, and actually, you brought up some good points, just talking about corporations and corporate spending, earnings, and investments. Talk about that.
And speaking to connect with Bobby on the Federal Reserve, since that is a topic this week, one thing that we were looking at, it's very interesting, since 2009, we've had just above 0% interest rate. Usually, as we know, when you get that lower rate, you get a lot of money that's invested by corporations because it's cheaper to invest.
Right.
But in looking at a lot of the figures, we found that's not where the money is going. We follow research from the Carlyle Group as one of many we do, and they had some interesting numbers on that. They said since 2009, companies had boosted the buyback of the stock. You can do one of three things with cash. You can buy your stock back, you can pay a dividend, or you can buy equipment and computers and make your plant bigger or whatever. Since 2009, buying the stock back, that's increased by 194%, huge number. And then dividends have increased by 66.5%. The investments that you want long-term that you normally see in a cycle like that have only gone up 43%. So in terms of market value, a lot of these companies have chosen to buy their stock back, pay a dividend, but not buy things that would extend a better recovery from a productivity point of view.
And that works great for short term because you'll see, because if companies buy back stock or pay a dividend, they're taking stock off the market, which reduces the supply, giving investors cash, which keeps the demand level, and that pushes the price higher. but that's just a one-time trick.
It is.
You want continued growth. You invest in machines. A new computer makes each individual employee more productive, something like that. That hurts in the short term, but helps in the long term. And now I think we're finally seeing that long-term lack of investment come home to roost. We've got 3 straight quarters of negative earnings in the S&P 500 companies. We've got the employment numbers not doing so well. A lot of that's, historically when you see that in late cycle, you see the employment numbers get worse because there's more people employed, less people need hiring. Companies start to get more efficient with each employee because those investments have to pay off. People get more productive. You got the productivity starting to go up. We're not seeing any productivity growth. In fact, this cycle's been some of the lowest productivity growth. And so that's why you're seeing the earnings come down, and you're seeing that one trick they were doing with buying back stock or giving out dividends is kind of it's running out of steam.
And unfortunately, we were saying this morning is the companies that can do that the most and spend the most are the ones that are doing that primarily.
Exactly.
So it's a lower multiple.
But it also explains to our viewers why we're staying conservative.
Absolutely.
In other words, if you're not seeing earnings growth, you're not going to see the stock market go up.
You can only buy back your stock for so long and kind of artificially inflate it. Eventually that just runs out of steam.
Right. Yeah. And the thing that we deal with, one reason we do this vlog is because of the fact that you can turn on the TV, you can go on the internet, and you'll hear these comments about market increases. But if earnings are not going up somewhere, sometime, it's going to stop. Yeah. Moving chairs on the Titanic, per se, I guess is the way of saying it. So on that note, we hope that you've gotten valuable information. It's given you some insight of what we're looking at, and we're going to keep you updated as the week progresses. And we also appreciate you sharing this vlog with others that you know. That helps us tremendously. So thanks again, and we look forward to talking to you soon.